Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi everyone, Mason Clement here. Before we get into today's episode, I wanted to ask you one question. Are you sick of the wild swings in the stock market and ready to try something different? Did you know that investing in stocks actually put you at the very bottom of a company's capital structure, meaning that there's practically 0% chance that you're going to get any of your money back in the event that the company files bankruptcy? So basically, you're putting yourself in the riskiest position for a questionable return. Personally, I hate the unpredictability and just waking up and having half of my investment gone when I didn't do anything wrong. So what a lot of people don't know is that you can actually make higher returns on a consistent basis by investing in the opposite end of the capital structure, which is actually the safest place to be, which is on the debt side in a first lien position. And you can do that by investing in real estate, and specifically investing with my company in notes that are backed by the land that we purchase. So if you're ready to diversify your income stream, go ahead and go over to scalablerei.com and click on invest in the top right corner. There you're going to find a form that you can fill out to determine if you're eligible to invest with my company, Celion Capital, and we'll be reaching out to you to schedule an introductory call and speak more from there. So thanks a lot, and let's jump into the episode. Hi, Scalable Investors. Thanks for tuning in to another episode of Scalable Real Estate Investing. I'm your host, Mason Clement, and today we have Sief Khafagi, who is a co-founder of Techvestor, which is a platform for investing in short-term rentals. I think it's going to be a really interesting discussion today, so thought I'd have him on, see if we could learn a thing or two about what's going on with them. So, Sief, how are you doing?
Good, Mason. Thanks for having me.
Sure, no problem. So, why don't we just jump into your background and your real estate journey and what eventually brought you to Techvestor?
Yeah, so most of my background, kind of going back to take us back all the way to high school days, because I think it's actually fairly relevant here, was where I started one of my first businesses, and I would sell about 2 or 3 businesses along the way, none of them for obscene amounts of money. And one thing that I've always realized and had a passion for was financial independence. Specifically because of the way that I grew up, right? Growing up in as a first generation American and having seen the importance of investing, or the lack thereof, I should say, in like the communities and community that I grew up in, I found that investing was really the only way out, right? For a lot of people. And I think many people realize that a little bit too late in life. I was privileged enough to realize that early. I was in college, San Diego State, and I was building a startup around basically beating the technical interview, coding and all that kind of good stuff. And did it decently enough where Facebook reached out and said, hey, how about you join us internally instead of doing this externally? I joined Facebook for about 4 or 5 years. Where I led the hiring and strategy for the second largest engineering team at Facebook, growing that from 8,900 people to a little bit over 1,000. And that was a great run in terms of understanding how to scale anything. Scaling from that large, that fast, basically 10x over a couple of years, was challenging in more ways than one. And while I was there, I found myself again in another privileged situation with a little too much money on my hands at the time. Single dude, just where do I put it, right? How do I do it? And I wanted to buy some real estate, and short-term rentals were interesting to me, but I never really pulled the trigger early enough until about the pandemic, and right after that period. And it was just super hard to get into short-term rentals, finding them, designing them, furnishing them, running, operating them. I mean, again, coming from a world of tech where everything was just automated, and building, scalable solutions there. Sabrina and I, she's my co-founder, we entered into a world where like, how can we fix this? And naturally we thought of software. So we built software, bought our first 6 short-term rentals for our portfolio, and, got some early feedback from investors. And really what they discussed was being able to diversify with what we're doing. And we built our first fund. And today we run a $30 million short-term rental fund that's exclusively available to passive investors. And it's our first fund of hopefully many.
Okay, you said first fund of hopefully many.
Yes. So
Okay.
we open new funds typically annually is the idea.
Okay, nice. So I guess would this be like a 506B or C offering or some different type of offering?
506C.
Okay,
506C.
so got to be accredited investor to invest.
Correct.
Okay, cool. So out of this $30 million fund, how many properties do y'all currently have?
So we'll land, I think right now we're about 25 million dollars allocated. So we'll land around 80 to 90 properties likely. We're generally in this range. I mean, we're wrapping up our first fund right now. So it just really depends on what this last couple of weeks push looks like in terms of capital. We're a multi-asset blind fund, meaning we don't know exactly what we're going to buy next. And we have several, obviously, different properties, all of them being single families for the most part in our portfolio. So it really just depends on how much capital is brought in, and that kind of dictates a little bit about what the size looks like.
Okay, but before creating this awesome multi-asset blind fund type of thing, you said y'all had purchased 6 properties, and was that just you and Sabrina pooling funds together, or how did that look?
Yeah, so those 6 were with investors who each put in, I don't know, about $250,000 each. And we helped them buy their own STR, right? It was their property, of which we went 50-50 with them on, like we did all the sweat equity, call it a JV for lack of a better word. And while we listened to feedback from these 6, the biggest piece of feedback, especially when we got them all together, was each one wanted a piece of the other person's property, right? They're like, oh, that's kind of cool, or that's a location I didn't think about, or it'd be nice to have a little bit of that. And what they were discussing was a syndication, right? Or a fund or a portfolio. And then as we continue to think about it and continue to listen to early adopters and early investors, that was a huge suck, right? Was $250,000 to do your own property is a lot of money. 2, you had a single point of failure, right? Meaning one property, one STR, one thing happens to it, you're kind of screwed. Versus a fund structure where you can accept, say, a 25 or 50K minimum, right? A diversified portfolio of dozens and dozens of homes, several states, several seasons, same tax benefits and everything throughout, right? And so that was a lot more appealing to our user base. That was like, hey, this really appeals to me. Not to mention that when you add the ability to stay in them, right now, instead of having one home you can stay in as an investor, as an owner, you can stay in 70 of them, right? And that's a really great kind of perk to investing with us as well, is your ability to, or option, I should say, to stay with us directly.
Okay, so how does that process work if someone wanted to stay at one of the mini properties?
So generally the idea here is like, a typical guest is going to go through Airbnb or Vrbo or something like that and book a property. If they're one of our investors, they can book direct, bypass the platform fees. And so from an investment perspective, we still retain the same amount of net income, right? It's the same exact math that we would have gotten that booking through like an Airbnb or a Vrbo. The difference is that the savings on the front end to the guest, in this case, the investor, is significant, right? 10, 15, maybe up to 30%, depending on the platform.
Okay, but it's not just a total free ride.
No, not a total free ride. We are investment first.
Okay, so the other investors have to at least benefit somewhat from it, because I mean it's lost revenue, obviously, so it makes a lot of sense.
Yep. So it's always an investment first.
Okay, that's very interesting. So I just remember that short-term rentals have, lack of a better word, a tax loophole where this can offset W-2 income. Is that correct? And so would investors in this fund also be able to utilize that?
So we don't give tax or financial or legal advice, right? As I'm sure you've heard on many of these podcasts. But the loophole that you're talking about, I believe, is when you own it directly yourself against your active income. The loophole you're talking about, I believe, affects active income, not passive income. For sake of taxes and sake of understanding here, we are generally considered a passive investment for the sake of taxes and as a syndication. So I can't comment on if this would have helped someone on their active income, but my belief is that it would not. right? Unless they own their own STR and manage it directly. Although I'm sure that loophole will probably go away sometime in the future.
Yeah, the more we talk about it, we should stop bringing that up.
I'm sure. I'm sure.
Yeah. Yeah. I mean, obviously there's certain CPAs holding entire workshops on it and stuff. So, I mean,
Yep.
you know, only so much you can do. You can't really contain it. I mean, it's right there. Anyway, I was just curious, but that's helpful. So I'd seen that in your bio that TechVestor has some proprietary tools that enables you to underwrite, say, 50,000 properties a month. So could you just describe that process and how that's even possible?
Yeah. So, like I mentioned, when Sabrina and I first started, first of all, the real estate market was like insanely hot. And so if you didn't know about a deal ahead of time, you probably knew about the deal too late. And so what we wanted to do, again, coming from a world of tech, is we really didn't like this whole idea of scouring Zillow, putting our assumptions into a spreadsheet, using tools like an AirDNA or other tools like that that would give us some element of data, doing everything manually and doing it one by one. Because what we found is we spend out 95% of our time on deals that didn't work, right? And so that's frustrating, as you might imagine. And so what we did is we connected, for lack of a better word, the MLS to data tools and APIs with custom and proprietary underwriting and really great partnerships and connections with of key people in key places. People like Scott Shatford from AirDNA sits on our board. Laszlo sits on our board, which was previously the SVP of analytics over at Realtor.com. And so these key partnerships allowed us to have open access to the MLS through certain partnerships. And so across 250 markets right now, which is where we have an interest in buying, we're market mapping those locations. So as soon as a deal or a property hits the open market, we know about it, we know the data, we know whether it's something we should consider pursuing or not. And then our human team, our head of acquisitions and his team, will actually take a look at the properties that do make sense, and then spend some time and energy there. So really what we're doing is we're automating a lot of the grunt work, data aggregation, underwriting. But at the end of the day, humans are the ones who will always be making decisions on whether we should buy this piece of shit or not, right? I think, at the end of the day, real estate is a human-driven environment, and just because it works on paper, you got to really understand what's in the bones, right? What's the location of that property? Does it sit on the wrong side of the street? Right? Those types of stuff. Those things are unfortunately not something that regulation or software can just tell you very easily.
Okay, that makes sense. But to an extent, at least your algorithms are saying this checks the initial boxes.
Yeah, for lack of a better word. And the data tells us that 94% of the time the deal doesn't work, right? So we're able to save 94% of our time and energy, right? And spend time on deals that actually have viability.
Okay. Do you ever source properties off market, just direct to seller?
Yeah, certainly. We've had a few that come our way that, right? I think generally as you become more of a buyer in certain markets, those opportunities typically present themselves.
Okay. But otherwise no active acquisition campaigns to source those leads.
Those things are starting, and it's predominantly because as we're market mapping, we learn the type of property to buy, or a better word for as many people know it as a buy box, right? So in one market, the buy box is very different than another market, right? How many bedrooms? I think, do you need a pool or not? How big of a lot? And so doing that blindly would probably be reckless, but doing it from a data perspective would be very advantageous. And that's something we plan on implementing heavily in Fund 2.
Okay, perfect. Yeah, because from my perspective, I've always seen it as, unless you have done what you've done and figured out a way to cut the wheat from the chaff and just, find what actually works. Like most of the thing, over 90%, just like you said, over 94% are not going to work on market.
Yeah.
That's where you go to sell. It's always they're taught, right? It's where you go to sell, not to buy.
Yeah, and you make money on the buy, right? And as many people will tell you, it's where you protect yourself and ensure you get good debt and all that good stuff.
Yeah, definitely. There's another guy I was talking to because I was considering doing some Airbnb arbitrage in my local market. And he was like, yeah, it's not the best time because all my clients, like he's running a cleaning business and he also had his own unit that he was doing arbitrage on. And he said, my clients' traffic has been cut in half because primarily they're relying on Airbnb. And since they changed their website to be more experiential based, like, a UFO type of home, or live in a cave home, or whatever it is. They're not even tagging things properly. And if you just have a simple apartment, that's so boring now. And so it's just overlooked. So what's
Yeah.
y'all's experience been overall?
So, I can't speak for anyone else, and I've definitely seen the mass media headlines and some of the comments that you're talking about. First and foremost, we don't believe in arbitrage. Like, we own all of our own assets outright, right? Meaning, like, we have full control. We're the owners of the asset that we're also Airbnb-ing. Like, we don't believe in arbitrages. There's way too much risk in our opinion when it comes to that, and their tax benefits. But specifically in terms of the assets we buy, first and foremost, we rarely compete with hotels. And you're talking about an apartment that oftentimes will likely be a studio, 1 or 2 bedroom at best, 90% of the time. And that's going to compete with hotels. We don't compete with hotels. We're buying 4 bedroom type homes, usually, or larger, with amenities. Design is also really important to us, and the experience. So for us, we haven't really been affected at all, because our type of product that we offer is not that one that would compete with a group of 2 that are traveling, right? Our average group size is 7 to 12 people, right? That it goes to any one of our homes. And naturally, if you're a group of 8 and you've ever tried to go to a hotel, let's assume no kids for a second. It's usually 3 to 4 hotel rooms, where the second that everyone goes to their own hotel room, there's friction, right? That friction is space, literally walls, right? Like, you're not with your group. And so when you're not with your group, the only amenities you have in that environment are within your room, or down in like the hotel pool, or the bar, or whatever it may be, unless you're going to go out and have a night on the town. But in an Airbnb, those 8 people can come together at their choosing in common living spaces in a private space, right? Where they're also, in an area that doesn't look like a hotel, like from a design perspective. All our properties are incredibly well designed and well equipped, because you got to remember that 95% of Airbnbs are ran by mom and pops. And so there is no like Blackstone or BlackRock in this space that's like crushing it on design or crushing it on management. And that's where we saw an opportunity to be that institutional like player, right? To go in, add really great design, great amenities. And also, you talk about Airbnb's algorithmic change when they went to experiences. So because we have tech backgrounds, what we understand is that all Airbnb is a product with a user journey, right? And that user journey is where Airbnb wants you to book something on their platform. We understand their user journey incredibly well from a technical perspective, meaning, how do we rank on Airbnb? In fact, in one of our markets, I think we have 12 properties, 8 of them rank on the first page, right? And so, like, in the other 4, well, with time, those are a little bit newer homes, but like, we know how to rank. It's just like Google, right? If you're not on the first page of Google or the second page of Google, how many times are you going to the 10th page of Google? Doesn't happen that often, right? And so we also know how to price, and we know how to design. We have automations in place from because we're vertically integrated in terms of the back end infrastructure. So these are things that 95% of our competition isn't doing. Therefore, I don't want to say that it's easy, but it's easier to beat the competition compared to, say, multifamily, where you're competing against billion-dollar institutions who have been doing this for decades with resources and capital and talent. We are that type of institution in this space compared to the mom and pops in many ways.
Okay. Yeah, that makes a lot of sense. And it seems like being a big fish in a big pond. So sounds like it's
Yeah.
great.
And our numbers are showing, we just had our biggest week last week ever. Or we're in December, at least at the recording of this episode, and we'll land this month 30% over revenue projections. So we're doing everything right, in our opinion, when it comes to driving revenue. And just in Q3 alone, I think we were around 52% higher revenue than the average property in our market, and 38% higher occupancy. So for us, that's what an institutional operator looks like.
Okay. So it makes sense in terms of like budget to actual analysis. But if I was an investor in this first fund, what types of returns could I expect?
So, for obviously disclaimer reasons, I won't speak to anything actuals here on this one, but I will say the type of return profiles we target. So the type of return profiles we target are going to be your 7 to 12% generalized cash on cash over a 5-year period. Obviously, that first year, there's a little bit more of a ramp because you're building and ramping and growing this portfolio. It's not like real estate tomorrow, right? Real estate is that you have to buy it, identify it, renovate it, design it, furnish it, list it kind of game. With a general idea of a 2x multiple over 5 years, right? Very similar to what you'd see in a typical syndication. So we're more cash flow focused than I would say typical growth equity or a development deal or a value add deal in multi. And that's really what we're optimizing for is like that passive income and that stabilized yield.
Okay. Yeah, that makes a lot of sense. And I think you mentioned a few times about the design and everything. So is that just a standard approach after you acquire the property? You're always doing something to it to make it just pop more, or what exactly are you having to do to each one?
99% of our properties, we do a fairly extensive renovation. And I'd probably say 50 to 60% of them are near full guts, right? Like we're purpose building, purpose designing to an extent these homes. Now they're single family homes. They look and feel like a single family home, but like everything down to the amenities, down to the experience, down to murals, down to colors, down to how they photograph, down to the beds and the bed formations and structures. Those are things that we pay very close attention to because the data tells us we have to pay attention to it, right? In some markets, a hot tub is really required. Some markets, it's not. In some markets, the difference between sleeping 12 and sleeping 10 is massive, right? And those are things that we understand. And that's why we optimize based on where we can get the most juice or the best return, right, for our investment in general. So it's not a one size fits all. Each market is hyper local, and we have an incredible team, which Sabrina leads on our operational side, which really understands how to stand these properties up geographically. And we do everything in house, right? We're vertically integrated. We're the ones designing, making the decisions. What are we renovating? Why are we renovating it? Outside amenities in a lot of markets are very big, right? In some of our markets, so like, how do we take this backyard and create it into an oasis, for lack of a better word? Right? How do we photograph, right? Do we use models in our photographs? Do we not, right? All these are hyper local decisions that we're making because some markets matter. Some markets are you optimizing for children, families, bachelorette parties? Like because our avatar in each market is different, the answer is quite different in each market.
Okay. And to determine which direction to take, are y'all just scraping the data using the APIs and stuff and just kind of looking to see? So the process?
Yeah. We're not trying to reinvent the wheel, right? Like what's really great about data, in our opinion, in this space is that if you're able to look at the data and see what's working and you're able to replicate it, generally you're reducing your risk of liability, right? Or risk of loss. And so if we see a 5-bed home in Scottsdale with XYZ amenities doing 200 grand, and we know we can go buy that type of asset for X and that pencils, all we got to do is do that, right? And the reason is we know we can probably beat that revenue realistically because of our revenue management team, right? We're able to drive a lot more juice out of it. But at a bare minimum, the property works as is, right? So we just follow the data. It's a single family home. We're not trying to reinvent the wheel. We're not building tree houses. We're not building 14-bedroom homes, right? We're not doing ground up construction. These are things that we're doing. That's like take an existing asset, which is single family homes, which we believe is a mispriced asset, turn it into a revenue generating full-term rental, which now becomes a business, sell that property based on the revenue that it's generating to some buyer, institution or non-institution, who's going to essentially want the stabilized yield, especially in an inflationary environment like we are today.
Okay. And when you say misprice, is that because you're unlocking this value, the short-term rental value? Okay.
Exactly. We believe it's a mispriced asset, right? Even though we're buying it based on values, because that's how single families have been sold for 100+ years, right? We believe it's a mispriced asset.
Yeah, that makes sense. That's really interesting. Because I focus on land, and it's very similar. Is where I can look at something and say, well, if I cut this up, it's subdivided, or if I add a road here or something like that, do some value add, then it's a totally different equation versus just buy and sell.
Yeah, exactly. And that's what we're doing, right? It's like it's almost like a development play, both of what you just described and what we do. Like there's elements of development, but it's not like what people think of when they think about ground up development, right? Like we're not doing like this high risk development. We're simply unlocking it and viewing an asset in a different way.
Okay. So basically make each property Instagrammable, right? So
For lack of a better word, yes. But I think our design team does an incredible job, but the properties are inherently Instagrammable for sure.
Okay, perfect. That makes a lot of sense. So just last question, you had mentioned you grew that internal team at Facebook like 10x. And I think that's personally one obstacle that I face. But you have these great ideas and you have like the $100 million offer in mind, but obviously it doesn't mean anything if you can't piece together the team. So just discuss that process and how you went through it and how you applied that to TextVestor.
Yeah. So, coming from a people background, the first thing we knew we had to do was assemble an incredible team. And in fact, the one thing that as a leader I'm proudest of is the team that we have. I genuinely think we have the best operating team in the space. And like a good people leader that I was back in the day, many of them were headhunted, for lack of a better word, sliding into the DMs as my team jokes of certain people, right? So, for example, Taylor, who's our head of acquisition, incredible sniper, incredible hunter, and probably tried to land Taylor for the good part of 2.5 months, right? Day in and day out, and finding him online and being like, why is he excited and passionate about short-term rentals, and does he want to come build this crazy vision that we have? John, who's our head of data, right? Not many people in this space known as the Airbnb data guy. So when we had an opportunity to land John, right, we snatched that and bringing him on our team. Our newest addition, which we have a verbal accept of actually as of this morning, as the recording of this podcast, was previously one of the head of revenue over at Vacasa for the last 7 years and took them from 1,000 doors to 38,000 doors. And these are people that are both opportunistic and headhunted. It's really important to me that we have the most incredible team. Real estate is 95% operator, right? Especially in markets like this today. And so being able to lean on experience and people who have done this before, and everyone else on our extended team, most of them already own their own short-term rental portfolios, right? Or 1 or 2 or 3 units. So these are people who have STR specific knowledge. And another reason or another strategy for how we actually de-risk the investment, in my opinion, is our team is incredibly industry specific, and we're a small, nimble team, but we know what we're doing.
Okay, so it's mainly just being a sniper and just laser focusing on these are the people I need, not necessarily the shotgun and casting a wide net and having 600 leads for a position.
No, I think like for me, you have to understand what you want as a leader. You have to be able to headhunt, number one, right? And understand why you need it. But I think when two or three of our key hires literally came at a time when we didn't even know we needed them. Right. And John and I joke about this all the time, right? He's our head of data. When I had a chance to meet John, I wasn't talking to John trying to recruit him. That wasn't the conversation. Right. And then you meet people. And I think this is one thing that I learned at Facebook. And granted, tech companies' growth very, very different, but we weren't ready to hire John. We hired John and we were like, we're going to figure this out because John's skill set for what we can do in a portfolio was massive. Right. And we figured out a role that would work around that. And I think a lot of entrepreneurs are typically very scared to hire early because they need to understand what they're hiring for. And that's most of the time, right? I would agree that you need to understand what you're hiring for, but we were very open and flexible with the fact that like, we don't know exactly where this is going to go, but this skill set is someone that I want on my team, and it's proved dividends time and time and time again.
Okay. Very interesting. Yeah, I'd like to pick your brain more about that. I realize that you got a hard stop though. What kind of person are you looking for? Are you looking for more investors, maybe for fund too, or who would you prefer reach out to you if someone wanted to get in touch with you?
Yeah, we welcome all investors who are interested in learning more about short-term rentals and considering it as an asset class, or other syndicators or fund managers who raise capital for multi and all those types of things. We work with a bunch of syndicators and bringing a short-term rental offering to your community as well. So we're happy to have those conversations, and you can reach us at techvestor.com. Myself, Sam, Sabrina, we're all available.
Okay, perfect. And just use contact information on your website there at techvestor.com.
Yeah, you can reach out. You can reach me as well at Sief@techvestor.com.
All right, great. Yeah, I'll throw that in the show notes as well. Thanks a lot for taking the time. This was very interesting, and I'm really curious and interested to see how your company blossoms, as I'm sure it's going to continue developing. So it's great.
Yeah, thanks so much, Mason. Thanks for the opportunity, and hopefully we brought some value today.
Oh yeah, absolutely.
All right, that's another episode of Scalable Real Estate Investing. Thank you for tuning in. Please be sure to leave a review and subscribe on whatever channel you're using to listen or watch these episodes. And also be sure to go to scalablerealestateinvesting.com, scroll to the bottom, and fill out the form to sign up for our email. And you could also reach me directly at mason@scalablerealestateinvesting.com. That's MASON at scalablerealestateinvesting.com. If you'd like to get in touch with me to either partner on deals or even be considered to do your own episode on this podcast. Thanks again, and have a great day.